Hi there, I'm Jonathan Bays, and this is our July investment market report. Another great month and a great quarter indeed for asset markets just finished. The Aussie market, one of the leading lights in global equity indices, outperforming the US, European, and definitely Chinese markets. And we were fueled by expectations and subsequently the delivery of interest rate cuts. We've now had 2 interest rate cuts. The last of which the RBA said maybe they'll watch the economy for a couple of months before considering whether to go again, but markets are expecting a further rate cut to 0.75% before the end of the year. But we also saw the passage of the really significant tax cut agenda that the Liberal government had planned. It's finally gone through both houses of Parliament, and as a result we should get some of that fiscal stimulus hitting the consumer economy in the next couple of months. So there's a lot of positives set to come through in the local economy, but as yet we're not seeing it. Construction's still very weak, building approvals down around 30%. We recently got the July consumer confidence figures, which also look pretty weak, in fact almost at a 3-year low despite the stimulus coming through. So it's going to take a little bit of convincing for the Australian households to believe that things are starting to look a little bit better. But on the whole, we do feel more optimistic about 2020. And I think with low interest rates, it's likely to be a year where earnings rebound. It's likely to be a year where we see an uptick in mergers and acquisition activity, and we think much of our portfolio has potential exposure there. So despite the fact that markets are on their highs and perhaps looking like they need to consolidate a little bit in the near term, as we look into 2020, I'm probably a little bit more optimistic than I've been on Australian equities in the past couple of years. So the next big event on the horizon for equity investors, in fact, will be the reporting season, which will kick off in early August here in Australia. It'll probably kick off a couple of weeks earlier in the United States. Not expecting it to be particularly positive in truth. Certainly here in Australia, the economy is still struggling and yet to see positive impetus from the rate cuts and the tax package coming through. So I do think it'll be a net downgrade season, if you will. Our hope is that we've tried to insulate ourselves away against significant risks. And so hopeful that we'll even have the opportunity perhaps to pick up some good quality companies into earnings disappointment in the coming month or two. It'll be really interesting to see how many of these high momentum names perform through reporting season, particularly given record valuations. We've touched on this before. You know, CBA back on a record high, 17 times PE. The other banks also too on higher PEs, despite earnings risks on margins as interest rates fall. You know, Woolworths continues to push high now on a record margin of a record multiple of 24, 25 times. Demerging the Endeavour Drinks business we think will ultimately be value destructive, and the consumer environment very tricky, but again it goes from strength to strength, as to do the healthcare stocks, which are now trading on record multiples as well. So I guess we'd be a little bit wary about these high valuation stocks going into earnings because it won't take much of a miss for them to see a really significant downgrade.
My name's Haydn Scott, and I'm an account manager at PIMCO here in Melbourne, and I'm going to be talking to you a little bit about our macroeconomic views and what that means for your portfolios. Base case for the next 6 to 12 months is that we do not see a recession. In terms of numbers, we're putting about a 20 to 25% chance of a recession on that, and when I say that, I'm talking about a global recession. We do see that a recession will play out over the secular horizon, which is the 3 to 5 year horizon, and we're putting an above 50% chance on that happening. What we do think though is that when that does play out, the recession is going to be shallower and longer, so much more of a U-shaped recession as opposed to the sharp V-shapes that we've seen in the past. So the title of our most recent secular forum was labelled Dealing with Disruption, and we've basically identified 5 key themes that could be potential disruptors to our base case over the secular horizon. First one is China. So they have higher economic and geopolitical ambitions, and we see that as absolutely a risk for disruption over the next 3 to 5 years. The second one is populism. In our view, populism rhymes with protectionism, so we see potential for a deglobalization of the developed world, which we think is a risk. The third, demographics. We see the aging population just increasing, the savings glut, and potentially having an impact on the economy. Number 4, technology. We're seeing a greater disparity between the winners and the losers from an economic standpoint. We think this represents a risk. Final one being financial market vulnerability. So in the context of high debt levels and low growth, we're very cautious on this space.